Palisade Radio is preparing to release an in-depth report on the fundamentals of uranium, including our top 3 picks for 2019. Sign up today at palisaderadio.com to be the first to receive our exclusive report.
Welcome back to another episode of Palisade Radio. This is part 2 of our 10-part uranium series. We kicked off just a couple days ago with Michael Alkin. He's a chief investment officer and founder of Sachem Cove Partners. And we had a great interview. If you have not listened to part 1, I would suggest that you put pause on this and go listen to part 1. Mike, you did an absolutely excellent job in layman's terms of laying out the entire fundamental reason behind why you got into uranium. Mike, welcome back to the program.
Thanks, Colin. Appreciate it.
So let's jump back in. Just a bit of a recap. In part 1, you gave your background starting off in the hedge fund world, then more recently looking into uranium, deciding uranium was a great place to position money, moving into the uranium space, and you talked through your research and how you came to the conclusion that this was quite an opportunity to invest in. And we left off with Kazakhstan and Cameco, both cutting production and the shutdown of MacArthur. So let's kind of lead from there and go to the next step.
Sure, yeah. So, you saw the Kazakhs announce a 10% cut in January 17. You saw MacArthur River temporarily idled, and then in December of 2017, there was some confusion around a Kazakh announcement, but essentially they were reducing by 20% what their planned output would have been over the next 3 years. So there was somewhat of a reduction there. And then you saw other mines having to go on care and maintenance. The Langer Heinrich mine, owned by Paladin in Namibia, was put down. And you have some other mines that are started coming towards the end of their their lives. So you're starting to see that supply discipline that you needed to come into play, and it's not rocket science for these guys. It goes back to it's just purely a function of economics. When if you're a producing uranium company and your contracts are rolling off, where you had higher priced contracts you were selling into, and now they're much lower, you have no choice. You have to pull supply out. Especially if you're a really high-grade mine. You don't want to sell your high-grade mine at low price, your high-grade uranium at those low prices. So, there's really not a lot of mystery behind it. That when I was saying earlier in part 1, I think I was talking about, you put all the pieces together, and I said, okay, well, there's not enough primary mine supply really typically throughout since the mid-'80s, and then there's demand that's growing, and we're kind of undergoing a nuclear renaissance now with these 58 reactors, and many are scheduled to come online, between 10, 12, 15 over the next few years, when you see mid-single digits and less over the last several years coming online. So you've got this demand that's there. Your primary mine supply isn't enough to meet it. It's been filled recently by inventories and secondary supply. The secondary supply is starting to wane. As I went through the inventories and I thought, what's really mobile? What can a utility access? There's not a heck of a lot versus the big number that people will reference, 1.5 to 1.8 billion pounds. You got to break it down into what's mobile, and it's a tiny fraction of that. And so you start to say, okay, well, you got the recipe here for something really starting to brew. And if you start to get the supply side discipline while you have demand starting to take off, you're going to see the price spike. And so, not much rocket science there, not very complicated. And that's what you're starting to see now. You've seen these big supply cuts. And the other thing too is, Colin, if you go back to I think several years now, since you've seen 1 billion pounds of uranium that are rolling off, and about 360 some odd million pounds that have been purchased under contract. So you've got this big demand that's setting up there that needs to be bought. And if you look around the world and you look at 2020, there's about a third of the uranium of the nuclear power plants that need to buy uranium under contract, and they're not going to be able to access the spot market like they had to before, like they were able to do that before, because the spot is drying up. This year, through September, you've seen 70 million pounds trade in the spot market, which is just through 9 months, which has already surpassed what you've seen in many years of full year trading. So that's being sucked out of the market. What was some of the inventory that was out there, some of the mobile inventory that was out there. You're not seeing the Japanese trade anything in the market. So people say, oh, they have all this inventory, but based on our math, we don't think there's that much that they have to sell. You've got 3 utilities, 9 reactors that are up and running, so they're back on the right track. From an underfeeding standpoint, we think because of really design limitations of the centrifuges, there's Western and Eastern. You've got the Russians, and then you've got Urenco, which is a Dutch-English conglomerate, and then you've got Areva. When you think about where those centrifuges are designed to spin the tail assays, they're kind of at the bottom end there, and our field work would lead us to believe that that the SWU, the separative work units that they're selling, which has been trading in the high 30s, we actually saw it tick up for the first time in I can't even remember how long, because they're literally at a point where they're not making the money they need to make on it. So you've got this kind of storm brewing where you have demand, primary mine supply being cut. These new projects that are on the drawing board have been delayed, licensing, permitting, everything else for this cycle. They can't come online until to meet that demand until the prices move appreciably higher, and secondary supply waning. So I kind of like that setup for the market, and so I think it's just a good time. And really, when you think about that fuel cycle, 2020 is when a third of the uranium that's required for the utilities isn't under contract. It's an 18 to 24 month purchasing cycle. So they need to really start coming into the market. Were it not for Section 232 in the United States, which was filed by Energy Fuels and UR Energy to U.S. miners, who petitioned the Department of Commerce on the ground, Section 232, on the grounds of national security. They asked the Department of Commerce to recommend to the President that U.S. utilities buy 25% of their uranium from U.S. miners. And the history of that is, if you go back decades, the U.S. consumes about 50 million pounds of uranium per year. And if you were to go back decades on that, they were able to produce what they consume, so kind of self-sufficient. Fast forward to today, the U.S. will produce less than 2 million pounds, and it imports almost all of its uranium from outside sources. And depending on the year, it can go 35 to 50% that they're importing from the Russians, the Kazakhs, and the Uzbeks. Now, one can make a very strong geopolitical argument that they don't have the same political interests or the same interests as we do right now. So if you think, when I say we, I'm an American, so when you think about it, the Russians own half the enrichment in the world. The Dutch and English through Urenco own a big lion's share of that after that, and then the Areva, now called Urano, the French, own a smaller portion of that. But the U.S. doesn't have its own enrichment capabilities. So if you think from a geopolitical standpoint, if you think about what the Russians would do with natural gas and hold it over the heads of the Europeans, well, think about what's taking place right now in the world of nuclear power. In the Russians and increasingly so the Chinese, they are financing reactors in the emerging market. They are providing the uranium. They are providing the conversion, the enrichment, and they'll even in some areas operate the plants, getting these countries completely dependent upon them. So they'll go out and say, we'll finance that for you. So they are very, very aggressive, as are the Chinese, in the nuclear fuel cycle. The U.S. has nothing. They have the number one nuclear power consumer in the world at 30% of global nuclear power. It's 20% of the U.S. electric grid. They don't, and the biggest nuclear weapon maker. Uranium powers the nuclear navy, so the Department of Defense needs it. Yet they have a mining industry that produces 1 or 2% or 3% maybe of their own uranium needs. The one converter in the country, which is Converdyne, owned by Honeywell, just shut down last year. They don't own their own enrichment. There's a plant in New Mexico that is owned by Urenco, but they don't have their own enrichment. So they are completely dependent on foreign sources. So these two miners, they filed a Section 232 petition with the U.S. Department of Commerce, and they said, listen, we want you to require the U.S. Utilities to buy 25% of the uranium because they have been living off of this cheap imported uranium that's being dumped into the market by the Russians, Kazakhs, and by selling it, by continuing to pound the market with uranium in a down market, they're saying they've depressed the prices. And they're saying on the grounds of national security, we have nuclear power. It's 1/5 of the electric grid. How can you let that go if we can't get the uranium? What if the Russians were to decide not to send uranium in? That could happen. I'm not saying it would, but it certainly can. But you are dependent for a portion of it. Sure, the Canadians and the Australians could fill some, but they have order books too, right? So it's not so easy to say, oh, well, our friends are Canada and Australia, which they are. But there's risk there. There's risk that the largest user of uranium in the world shouldn't be exposed to. So they are asking for that. What that's caused, if you are a U.S. utility, and even a European utility, if U.S. uranium has a quota of 25%, that would be about 12 million pounds. Now, I've seen arguments, people say they never could produce 12 million pounds. The U.S. could produce 12 million pounds, but not tomorrow. They could probably do it over a few-year period, 3-4 year period. So you can get some sort of a phase in. But if that happens, if 232 went in at a 25% quota, and all this horse trading takes place in these back rooms, so who knows if it's 25% or who knows if anything will happen. But Commerce did pick up the argument, the investigation, and they didn't have to do that. But what would likely happen is you would see U.S. uranium spike higher, and then foreign uranium, which couldn't come into the U.S. for 25% of the U.S.'s needs, would probably be lower. So you'd have this bifurcated market, if you will, this two-tiered market. So the U.S. power plants that are in need of uranium, some of them, because that third I mentioned before of they're not under contract, rather than enter into prolonged contract negotiations with suppliers who they normally would be buying from, they've stepped back and said, well, wait a second. We don't know who we're going to be forced to buy from. By April of next year, the decision has to be made. So why don't we just step back from the market and see what's going to happen, which is why I think, you are seeing a little bit of a hiatus, even though spot price keeps moving higher. But that's why I think you're seeing the spot market volume so much higher. You've had some financial intermediaries like Yellowcake, the London-listed IPO, which is storing physical uranium, but you're seeing utilities in the market because they don't want to run low on uranium. So once you get clarity on Section 232, then I think you see what really moves the market, which is big long-term contracting. And when you see 7-10-year deals and you see at much higher prices, because the reality is the miners can't sell it anywhere near what the pricing is right now. And, it's been a nice time for the U.S. or for the global utilities. They have not been having to pay high price for the uranium. So as their contracts rolled off, there was a whole new dynamic that took place, which is really the carry trade, which is you had some of the big major investment banks post-Fukushima go to the utilities and say, listen, don't use your balance sheet and tie up contracts, or you don't know where the price of the uranium is going to be with all this demand that's disappeared with Japan going offline. Let us enter into trades for you. And we have big balance sheets, and we'll enter into short-term contracts with you. We could do 1, 2, 3 years, so you don't have to sign a 7 or 10-year deal. Let's see where the market settles out. And we, the traders, will go out and secure the uranium, and we'll cover your needs in the future. And for the utilities, they say, wow, that's pretty cool. We don't have to, we don't have to really lock ourselves up here. There's a lot of uranium out there in the world. And that was great. And that kind of, for several years, it almost became like a drug for them. because they had a lot of uranium in the spot market. They had this carry trade where they had the banks going out and covering their needs for them and delivering when they needed it. But, things change, right? So times change. And as things change, it's really one of the things where being a generalist, I love, because over 20 plus years in the hedge fund business, I've looked at probably every industry. And what I concluded was there's really two areas that I'm not going to invest in. One is biotechnology, because I have no idea if a drug in phase 1, 2, or 3 is going to work. There's no amount of research I could do because I probably got a D in biology and a D in chemistry in school. And big money center banks, because those balance sheets are so ridiculously opaque. But aside from that, one of the things I learned about being a generalist, and I didn't know this 20 years ago, you'd start out looking at a new industry and be intimidated. You'd say, oh my God, how am I supposed to get any sort of an edge on this? Everyone knows this. They're in the market. They do this every day. And then what you realize is if you're a fairly bright person, and then my wife would argue against that sometimes when she sees some of the things that I'll say. But if you're a fairly bright person, then you have a framework. When it comes to investing, there's pretty much any industry, you can get your head around what the demand drivers are. And then once you get what the demand drivers are, then you go out and find the people to talk to really just keep educating you. And if you're a sponge, you can get your head around what drives it. And again, going further into the cycle, whether it's a retailer that you're looking at or an industrial company, customer, suppliers, vendor, the whole thing, you put the mosaic together. But what I learned years and years ago, and it stayed with me, is the experts get complacent, or the experts take the narrative of the existing situation and they extrapolate it. So if you've been in a really big bull market, nothing can go wrong. And we've seen it with time and time and again. And when you're in any industry, and when it's in a really big bear market, it's never going to get better. And when you come in with a fresh set of eyes and you step back and say, okay, are there changes brewing underneath the surface that those who do this every day are just kind of complacent, and they've kind of adopted a narrative, and psychology takes over. And oftentimes in these very, very deeply cyclical industries, you can find that. And so that's what I think you have here in the world of uranium. People look at the utilities haven't been in buying. They haven't needed to buy. They had so much uranium out there. And all of a sudden, step by step, and I've seen this over 3 years now, piece by piece, the things that needed to happen are happening, yet you don't see the price respond right away. Now, you've seen the price of uranium. It troughed at, I think, 17 a couple of years ago, and now it's 28. And spot has moved since you've seen the MacArthur River cut from low 20s to $28. But the contract, the term price, the longer-term price, when these utilities come in, that's where I think you see a big move. And because I think they know that mobile inventory isn't plentiful, I think the carry trade has started to slow. Those big banks who started, they're not in the uranium trading business anymore. Rates have moved up, so when you're using your balance sheet, if you have no cost to borrow, basically, because you're at 1,000-year low interest rates, that matters. But when rates are starting to spike now, you don't know what you're going to have to. If I'm a trader, I don't really know what my cost of money is going to be. So you've seen less of that. You've seen the enrichment where conventional wisdom is, they can underfeed, and costs don't matter. Well, they do. And when you start talking to people who are deep into that cycle, you realize, no, that's not true. There are changes taking place there. And so all these little pieces that have all formed this mosaic of negativity, now that they start to change, when people take their eye off the ball, the industry is underfollowed by investment professionals, by buy-side investors, hedge funds, mutual funds, and by the sell side, the guys writing research. Man, that's a great scenario. And so that's just kind of how I have viewed this, the cycle and where we are right now. So it gets me excited about it.
So you're a fund manager. You know how guys in this industry think and how this industry works. How is it possible that an opportunity like uranium, once you've taken even just a topical view of the facts, is this good and yet nobody is in it? I mean, gold bugs, looking at kind of a similar type of investor. They can claim that gold is cheap, but it's nowhere close to as depressed as uranium is on any metric. Right. And uranium has been in a bear market for so long. How does something like this just pass everybody up?
Yes, that's a really good question. So it goes back to who are the participants in the industry and who are the participants who's buying the stock, right? So in the last few years, all these companies have diluted so dramatically their shareholder base, almost all, at varying levels of degree. Some much more egregious than others, but when you're not producing and you're burning cash, you got to go to the public market and get money. But what's kept that afloat really has been, obviously you have some natural resource funds. You've got some funds in Canada, some funds in Australia. Up in Canada, you have flow-through financing that can help these guys along. But it's been a big retail investor base. And you have some real uranium bugs, right? Guys who really believe it and do some really nice work, and they're retail investors, and really smart. But they are not the marginal capital, as I was mentioning earlier on the call. I think in part one, the marginal capital. The capital that takes these stocks much higher is the institutional money. And that institutional money, for the most part, there is institutional money in there, but for the most part, the generalist money, the generalist fund that is going to say, okay, we look at anything, we're smart guys, smart women, we could figure it out. What do we got here? Uranium has not been on that list, even regardless of how cheap it is, because it's not like any other industry I've ever looked at. It is so complicated and so opaque. It is by orders of magnitude more complicated because you have that primary supply, you have the secondary supply. In the secondary supply, you have so many different sources of it. You don't have great data. You have the WNA, the World Nuclear, which puts out data, and if you peel the onion back a little bit, you go, uh-oh, that doesn't make sense. Look what they're including in supply. And then you go to the consulting firms and you go look at that, what they're putting out there, and you're like, that kind of looks like they're kind of walking the fence a little bit. They want to be on the right side of whichever direction it's going. So I'm really not sure about that. And then for the big institutional investors, the way it works is you see something, it's cheap, you call the banks you're doing business with. The way it could be Goldman or Morgan Stanley or JP Morgan or whomever. And you call them up. Now in Canada, you have your banks who've been there all along, and those stocks are owned by the resource funds already. Or if they're resource investors, they don't want to hear about it because they've heard the term in uranium. I've heard it 100 times. I don't want to hear it. And just like the experts in the industry, the experts who focus on investing in one industry fall prey to the same psychology. When things are really good, it can't get worse. It can't get better. It can only get better. And when things are really bad, it can't get worse. And that really happens in whether you're a tech investor or a packaged goods investor. When you just focus on that world, you get sucked into the narrative. So now you have a commodity that's down 95%. And look, at the time it was a $4.5 billion market cap. I don't know, is it now $7.5 billion, the whole industry, and half of that is one company. If you're running a $2 billion hedge fund, you can't invest in anything other than Cameco, if at all. But even then, if you were to have a 3% position, it's a $60 million position, and that's a big position in even Cameco. So it eliminates so many funds from even looking at the sector or the category. Now, if you're running a smaller fund, you're running $50 million, $100 million, $200 million, you have that flexibility because you can take positions in smaller companies, but those funds don't have the resources. They don't have 15, 20, 25 analysts that are looking at different things. They don't have the manpower. And it's an important point, I think, because the hedge funds have outperformed for so long in rising markets like we've seen. Hedge funds typically don't outperform because they're hedged. They don't have 100 cents on the dollar long, right? They may be 20% net long, 30% net long, 40%, and when the market's going up, they're going to lag. And after a while, hedge funds charge big fees, right? So it could be 1.5, some of them 2% of the assets under management. The incentive fee, they can get 15 or 20% of the profits. And there's been some fee compression there. But after a while, the people who allocate money to hedge funds, the big institutions, the endowments, the pension plans, they've seen now almost a decade of underperformance. So the pressure on hedge fund managers is even greater. You've got to perform sooner. When I started in the business, at my first fund, you might send a letter out once every 6 months that said, here's what we own, and here's a couple of our positions, here's kind of why we like them, and that's all you really told them. Now, but back then, the core investor of a hedge fund was a high net worth individual, and hedge funds were secretive, and they were mysterious. Now there's 10,000 of them, and the money comes from institutions themselves, pension plans, endowments. They require constant reporting. It could be some weekly, some monthly, but it's definitely quarterly, and most are monthly, where they want a lot of insight into what your portfolio is. So when you're underperforming, you don't want your investors to say, "What the hell do you own this? God, you're underperforming, and you own this commodity that's down 90%." They need to find things that are working on a regular basis, because they do have less gross net exposure along the market, so they need stuff that's going up at least with the market. In a commodity like this, you don't know exactly when it's going to turn. So the big guys are eliminated. The small guys don't have the resources to learn this complicated industry. Most of the sell side is gone. Like I said, there are some guys at different banks that do some nice work, but some of them have been long and strong throughout the turn. Not all of them, but some of them. So, it's okay. Well, what's different now? And so this big pool of buyers, and mutual funds really don't buy 10-cent stocks, 20-cent stocks, 50-cent stocks. This big pool of buyers isn't there. So, but what happens is, as the industry experts are all lulled to sleep with the direction of the extended market, as the industry investor experts are lulled to sleep, thinking nothing's going to change, changes happen. And when you bring a fresh set of eyes with steeped in a foundation of a process and understanding the parameters that you're looking at, with a foundation for investing and wrapping your head around, if you spend the time and drill down and become part of that industry, you don't have biases. You learn what happened 15 years ago, 12 years ago, but you're not ingrained in it. So you bring a fresh perspective to it. Now, in the case here, what I suspect, the view I have is there are a lot of changes taking place for the positive that will influence the price of uranium much higher. And when that happens, the market will notice. And I can tell you, just from speaking to people over the last year and a half, 2 years, 2 years ago, if a friend of mine running a hedge fund was talking to me about uranium, I'd say, "What, are you out of your mind? Like, uranium, what is that? I haven't even thought about uranium." And I'm talking even some guys who run they're at generalist funds, but they're in the commodity space. They forgot about uranium. And I could, now it's different. Now I'm not saying that there's much capital being committed to it, but it's like, "Hey, I know you're doing that uranium fund. Get me up to speed on that." Because I've been hearing it in different people I'm talking to. So when you hear that, you say, okay, well, there's this level of awareness that's been raised because the commodity is moving, the supply is being cut, the story is starting to unfold. And a lot of times people need proof. They don't want to hear, here's the thesis. They want to see it working, and they're much happier. There's this old saying, don't catch a falling knife. Right, so commodities down 90%, the stocks are down 90%. Many people are happy to buy it up 100% if they think it's going to go up several 100%. And so that's what I think is happening. It's just a lack of eyeballs on it, a lack of institutional eyeballs, and more importantly, a lack of eyeballs with a lot of capital. But I think that changes. The market cap of this industry was, $60 billion not a decade ago. So if it's $7 billion, it can get back there. It just needed a little bit of time. But one of the things that really struck me, Colin, when I came into this space and I really started peeling the onion back, was when I looked at the bull case for 12, 13, 14, I said, no wonder why it didn't work. There was no talk of the underfeeding. There was no talk of the DOE supplies that were being pumped into the market. There were a lot of things that I thought, wow, it didn't make sense. So, and as I look at it now, and like I said, I came at this through the eyes of a short seller. And it's not like, oh, hey, I want to be the eyes of a short seller. It's what I've done my entire career. So, and I've had a lot of experience at it. And that's kind of how I did it. And I said, if I could prove that bear case, that risk reward is still there for a short, there's no way I'm looking at this space any longer. And the more I learned, the more I looked, I said, I can't see what the bear case is. And then it's a matter of saying, well, what's my upside versus downside, my risk versus my reward? And that's where the asymmetry started to jump out at me. So that's kind of how I'm viewing the uranium space right now.
Mike, you were not a participant in the 2002 to 2007 bull market in uranium, but as an investor now, one can only dream of kind of a mirror image of that run reoccurring. And I watched a lot of money made in the commodity sector during that time frame. Everything was up, but nothing compares to a uranium bull market. And you mentioned $6 billion versus $60 billion. And what people might jump to the conclusion is that's a 10x return, when in fact Cameco will probably only go up 3x, and the juniors will probably go up something like 100x. So huge returns here. What do you expect from where we're at?
Yeah. So I think one of the things I've noticed, and I didn't really, Twitter wasn't around back then, and I didn't have, for 20 years I had no exposure to a retail investor. My friends, right, my real world friends that are professional money managers, but now I've seen it because this has been in the hands of retail investors, and Twitter's out there, and there's a really good uranium universe on Twitter. One of the things I think people need to be cognizant of is it's been a 7-year downturn, and a lot of these companies have issued a lot of shares. They've diluted, right? So if you're looking on the valuation, right, how can you value a company? Well, enterprise value per pound in the ground, and then you could look at it on a total pounds or measured and indicated. I like to look at it on measured and indicated, which is more certain. And then, but what's that enterprise value? So you have to think about what goes into that. Well, the share count, you got a lot more shares, right, out there. So as you've diluted, and have kept diluting throughout the downturn, that dampens the upside potential in some of these. So I think it's very important. And the same thing if you're looking at it on an enterprise value, however one wants to look at it. You can look at it on a cash flow basis. You could do a DCF. You can look at it on many different ways, right? And I don't tell anyone how to value these things. I have my own way. But you have to look at each company individually. Not everyone that did in the last cycle is going to do the same cycle. As to where the price of uranium goes, I don't know. I see people saying, "Oh, it's going to 200, it's going to 150." I have no idea. I know that it's got to go. I think it's got to go 60, 70. If you want some of these new projects to come on, you've got to get there. And you got to go back to what was going on in the last cycle. The physical hedge, the hedge funds started getting into the space really late in the game. And they started buying physical uranium when it was at 70 and 80, and they drove it all the way up, right? So I think it peaked at 137 in 07. Well, you had a lot of hedge funds buying physical, and then all of a sudden the global financial crisis came. And it didn't matter if you were a successful hedge fund or struggled during that. Everyone across the board in hedge fund land got withdrawals. Some might have had 10% of their assets withdrawn. Others might have had much, much more. And if you were owning physical uranium and you were a generalist fund and it wasn't really core to what you did, when you're looking to liquidate some of your positions, see ya. That's where it's going. And you saw those guys get out. And there wasn't a market for it. And it pounded the price down. So, I think people really need to, look at how much dilution has occurred at the company, and look at it on a project-specific basis and try and understand what the valuations that they're looking at on different metrics. If a company is not a producer, when you see re-ratings occur, you tend to see companies that have gone from cash consumers to cash producers get re-rated pretty nicely. But you have to understand the valuation you're starting from. You always got to know your starting point and what's that worth. If they have a couple of projects, how many pounds per year are they going to produce, and what's the price that they're going to sell it at, and what's the margin what's their cost, right? And then how much cash flow is that going to generate, and over how long is that mine life? And so you've got to make some assumptions, and I think that's where people can get bagged because if you don't do that work, because what tends to happen is in the mining industry, you have some a lot of these companies are always in the business of trying to drill and explore, right, and develop. And that requires capital. And when that requires capital, that requires stories. And it's kind of, in a way, it reminds me of biotech companies in a sense. Early in my career, I was at one of the funds did a lot of biotech, and I knew enough to know I didn't know better, but I'd listen, and we'd have meetings, and I'd listen. But what struck me was when you're in the business of drug discovery, you're always raising capital because you got to fund those projects because you're not generating any revenue off of those for quite some time. And to do that, you need a really good story. And that happens in the mining space. If you're out looking and you want to drill and drill and drill for a project, you don't even know if something's there, and then if it is there, it's not going to generate cash for quite so many years. You got to have a good story, and oftentimes the story is better than the reality. So, I always you've got to really bring in like an auditor's degree of skepticism to all these companies. You have to do your own work, and you have to understand what it's being valued at today when you buy it. And what do you think the value is when it goes forward? How do you do that? Well, where did they trade in the last cycle? Where are they strategically, right? Are they, the first order is, okay, so maybe where does the market re-rate? What do they re-rate first? The cash consumers, the cash producers, and then what's beyond that? Are there strategic values? Are there hidden assets on the company's balance sheet? Do they have a license or a permit for something that no one else can get? Can a strategic buyer come in and take them out without any problems? Can the Russians go in or the Chinese go in and buy that company that you really like? Are they in a geography or part of the world where the governments won't allow that to happen? Are they in a part of the world where their projects could get permitted in 6 months or a year versus 10 somewhere else? So you really have to look at these different things, and rather than just say, in the last cycle, this stock went up X, and now it's going to go up X again. Now, there are some that are dramatically undervalued, and there are some that are more reasonably valued. So it just depends on how, it really is important to do that next level of work. Once you've got, because if the macro uranium cycle doesn't work, none of them will work. But once the macro cycle starts to kick in, you tend to see some of the really garbage companies will rip to the upside. You tend to see that, but for the real sustainable ones, like, it's really important to drill down and understand what you own.
Excellent. Well, Mike, I can't thank you enough for coming on the program twice, in fact, and spending over an hour and a half sharing your thoughts. I really think that you've broken that down in a more digestible fashion than I've heard anybody else do it. So I think listeners will have great takeaways.
Well, it's my pleasure. I enjoy talking about it. I really, you and I were talking before we started the interview, and you're saying like you became hooked on uranium, right? And I can see it. It's a fascinating industry, and I continue to learn. You keep, no matter how deep I am into the fuel cycle and talking to people all over the world and understanding it, there's always something new you pick out. So it's a really fascinating industry.
Yeah, and it's got so few names at the bottom. I was looking while we were on the interview earlier, just at 5 or 6 juniors, and I mean, for $100,000 each, those stocks will all be up 50% tomorrow, and that's why these things just, when they start to go and gain momentum, it's incredible how quickly they move.
It is, and the thing, Colin, that has really struck me is, when I've looked at resource industries in the past, you've got producers, near-term producers and developers, and I kind of shied away, just my style, from the poke and hope, because, what is it, 1 out of 4,000 or 5,000 holes lead to anything, right? It's just a lot of dilution. And what struck me here when I really started peeling back the onion on the companies is, hey, you've got some real companies with real resource in the ground that don't have to spend a lot on drilling. It's not, but they've been destroyed because the market. So you don't have to, if you don't want to find some really cheap companies to take a lot of exploration risk. So I found that somewhat unique in looking at this. Just one more thing that made me excited about the space.
Yeah, absolutely. Well, Mike, anybody who wants to get in touch with you, I assume that your fund does accept investors if they're either accredited or qualified?
It's only for accredited investors. Yeah, Colin. It's a private partnership. They have to be accredited, and so wherever someone lives, and we have a website, and I have a partner who handles all the operations and all that stuff, and they could do that. But yeah, it is only for accredited investors.
Excellent. Okay, well, Mike, have a great evening, and thank you so much.
Thanks, Colin. I really appreciate it. Take care.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?